Hey guys, Ross Gibbons here with the weekly market video for Wealth Empire, and today I want to go ahead and jump right into it because there's a lot going on in the gold market. Now, what you're looking at right now is about the last month of gold prices, looking at the gold futures contract, and it's been a pretty clear downtrend for quite a while, especially the last month. It's been really cleanly descending, and then something happened on Sunday evening. And let me zoom in so you can take a look at that. Sunday night, around 8 o'clock p.m. Central Time, someone came in with some pretty heavy sell orders, and that's this candle right here. This is a 1 hour candle. Um, and smashed gold from around 1132 down to about, well, it went down here to a low of about $1,080 per ounce. So absolutely huge move for the middle of the night on a Sunday. And you can see the volume. See this volume candle hiding behind there? You see how high that is in comparison to the average volume at that time of night for the last several days. So what that's done is trigger a sell-off in gold, and it's also triggered a pretty big sell-off in an ETF that I follow, and that is GDX. It's the Market Vectors Gold Miners ETF. What it is, a very basic exchange-traded fund comprised of some of the largest gold mining companies in the world. And here's their top 10 holdings you can see really quickly. There's Goldcorp, Newmont Mining, Barrick Gold, Franco-Nevada, Silver Wheaton, Newcrest, all the big names in the mining industry. Now, why I bring your attention to GDX is because I think there's a big opportunity here that most people are going to miss. So let me show you what I mean by that. Now, when most people trade gold, they focus on one of two things. They're either trading the futures contract, that's this on the top, /GC if using TD Ameritrade or most other platforms. And if they're not futures traders who want to hold it longer term, they're using this ETF, GLD. It's the most popular gold ETF out there. There's tons of volume. And all it does is try to track dollar for dollar as best it can the movement in the price of gold. Now, this is the last 9 years of trading, and as you can see, it does pretty well at that, right? Captures almost all the upside here on the big run up on 06, 07, 08, 09, and then on the downside, you're within 0.5% of the movement there. So you're going to lose a little bit just due to the extrinsic value of the options and some of the costs involved in the futures contracts required to make this ETF. But for the most part, GLD will move almost one for one with gold. And this is what most people use to play it. But I prefer GDX, and I want to show you why. Now, you guys know me. Typically, I'm a bit of a value investor. I get more interested in stocks when prices come down versus when they go up because I think you're getting a better bang for your buck. And what I want to show you with this chart, again, the last 10 years of trading is GDX, that's the chart on the bottom, in comparison to the gold futures contract, GDX exaggerates all the movement in that market, and that's great for you when you're buying. So let's look at the last several moves in this commodity, and you see right in here where gold fell around 34% in 2008. On the other side of that table is GDX, which fell 72%. The ensuing run up, they gained about 182.5. You saw 323% from GDX. And you're seeing the same thing each time there's a swing. 20 versus 40, 17% up here versus 41% up. This one fell 35, where it fell 60. It's up 21. It's up 41. And it's almost a double movement every time this happens. And the reason is very simple. GDX on the bottom is comprised of actual companies, actual stocks that have expenses and have profits and have employees and pensions to pay. And people get worried about the insolvency of those companies. So when there's a sell-off in gold, everyone freaks out and thinks, oh, it's getting too cheap, they're going to go out of business, all these companies are going to fold, and they oversell GDX. It becomes oversold. Therefore, when gold once again turns positive and starts an uptrend, it has a lot further to go because it's both capturing the upside of gold and also reclaiming that oversell off from before. So this is why I think there's a huge opportunity today. What we have is GDX at 10-year lows. As I'm typing this, Monday right before the close, GDX is trading just under $14 per share. Now, even back here when gold was down, this is 2008, when gold was down around $700 an ounce, GDX wasn't this low. So now I've got all the same companies with newer technology, with healthier balance sheets, with gold trading $400 an ounce higher than it was then, and we're able to buy these at an even cheaper price. So again, GDX, you're getting the top gold miners in the world. You're getting them at less than book value, which is actually a rare opportunity. And a lot of people ask me, how do I know when the bottom in gold is coming? When is it time to buy metals? Honestly, I don't know, and no one out there knows. Anyone who tells you this is what's going to happen with gold is lying to you, and they are simply guessing at what's going to happen. What you have to do is be an educated investor and not a roll the dice speculator. And what that means is you want to look for opportune times to buy the metal based on supply and demand. So I did an article for Wealth Empire. You can see it in the archives several weeks ago about the cash cost of gold and silver. And what the cash cost is, it's just a rough estimate where people try to figure out how much it costs mining companies to get the gold out of the ground. And here's why that's important. If I can get gold out of the ground for $1,000 an ounce and then sell it for $2,000 an ounce, I'm going to do it all day long. I'm going to make as much money as I can. But if it still costs me $1,000 to get it out of the ground, and now I can only sell it for $1,100 or $1,000 or even $900, I'm not making much money, or I'm breaking even, or I'm even losing a little bit. So what happens is when you look at the big picture of gold, when you get prices down below that cash cost, supply and demand takes over. Supply drastically shrinks when prices get too low. Miners don't want to pull the stuff out of the ground if they're going to sell it at a loss, and that causes prices to once again climb, and then the miners step in and start pulling or mining more gold. So on top of cash cost, this is a widely debated issue. You can read about it all over the internet. Gold bugs are everywhere. On top of cash cost, there's something called all-in sustaining cost, and that's just kind of a more encompassing measure. Now, this is a rough estimate of the big miners' all-in sustaining cost for 2014, so we don't have updated numbers here. But as you can see, the averages here around the globe are somewhere between around $850 and $1,100. So if we call this just ballpark it, let's say it's $1,000. That's a rough estimate of what it costs them to get it out of the ground per ounce. If prices get too close to 1,000 or even below 1,000, you're going to have these guys where it's costing them a lot more stop producing. These guys will slow down. These guys will slow down. And again, like we just talked about, the supply will decrease and price will increase. And that's where we are now. When you had $1,900 an ounce gold, this isn't all that relevant because they're all making money. And I've even got a chart here that shows the exact numbers, I believe. So we're seeing the cheapest gold miner out there, the most efficient one, Polyus Gold in 2014 was at an all-in cost of about $825. Goldfield, Sibanye, Anglo Gold, they're all well over 1,000. So with gold today trading at $1,102 an ounce, getting dangerously close to that. And this is when I like to get into gold, when it's trading at a price where these guys are about to lose money, and we're going to let the market factors and supply and demand take over. Now, if I'm buying in gold, could I do GLD like we talked about? Sure, absolutely. But I am much more interested in GDX. I'm getting the best companies, the best miners in the world, the largest ones trading below book value. And instead of just buying GLD, which is just a big chunk of metal, I'm getting real companies that have real earnings and will continue to produce revenue for me as an investor for years to come. And when we see gold come back off these lows, we will see an exaggerated move upward from GDX.